Hi, everyone. Welcome to the latest Carson's Take 5 with Ryan and Sonu. Sonu, I'm standing in the middle of the universe, Times Square. You see it here?
There you go. Look at that. And I thought I heard some Michael Jackson music.
There was a one of those carts where they drive you around that had Michael Jackson playing right before we started. But
That's
listen,
what you should have been in.
Exactly. But there's a lot going on. Again, we're titling this one, How Bad Will It Get? I think that's the title, right? Is that the title we agreed on?
Yeah.
How bad will it get? Yeah, that's what we're using now.
Why not?
We've seen an incredible amount of volatility over the past week or so, Sonu. Really, when you think about it, there's three things that they're telling us why. There's the Japanese yen carry trade, which we'll keep real simple. We'll talk about that. The economy slowing, and also the Fed behind the curve. Those three things have been causing a lot of volatility. Maybe let's start with the Fed. We've talked a lot about that. The Fed behind the curve, what does that mean, really?
I think the idea is, look, inflation's, you and I have been talking about this for a while. We've been saying that inflation is last year's problem. The Fed got spooked. I think that's a fair way to characterize it. The Fed really got spooked by the higher inflation numbers in the first quarter of this year. And so they've delayed rate cuts, interest rate cuts. And we think, we've been saying that the economy probably needs rate cuts. Risks are rising. Doesn't mean that we think there's a recession right now or around the corner for that matter, but there are higher risks. And the Fed could stave off those risks if they'd acted already. I think there's still time, but I think that's what markets are expecting the Fed to act sooner rather than later in easing monetary policy. Yeah,
I mean, listen, interest rates are up over 5%, right? Yeah. You can't keep them there forever. Eventually, it's going to start impacting parts of the economy. It was, as you pointed out recently, in 2018, a 2.5% Fed fund rate really started causing some trouble that was out there. So again, the Fed's behind the eight ball in our view. Inflation is better. We think September is going to be that first cut. I mean, I know we don't have a ton of time. We call this Take 5 for a reason. So when we get into it, about to get run over. Look at that. Look at that. That's the hot dog guy. The hot dog guy almost ran me over.
This may be a Take 3.
Yeah, maybe I should get a hot dog. I'm staring at these hot dogs. They look wonderful. Nonetheless, what was I asking? 50. Will it be a 50 basis point cut, 25 basis? And by that, it's 0.5% or 0.25. Usually they do 25 basis point. You think we'll get 50 in September?
My view is that they should do 50, but nobody cares on what I think. What markets think is a 50 basis point cut, 0.5 percentage points is coming as well. There's a 70% probability of 0.5% cut in September. I don't think the Fed is inclined to do that. So the question over the next 4 weeks, we have about 4 weeks before the meeting, is do they get to where the market is and cut 50 basis points, 0.5 percentage points in September, or do they talk down the market? I think that's going to be the push and pull over the next 2, 3, 4 weeks.
I'm off mute. Okay, it's very loud. I was on mute there because there's like siren. New York. Listen, there's no recession in New York right now. It's 10 o'clock at night. It is packed. Okay, so that's that. Let's talk about the economy slowing, right? There are some signs. We've seen some signs of little cracks with the consumer, little cracks maybe if you look at some of that manufacturing survey, so to speak, initial claims. How many people are filing for unemployment? It's been increasing a little bit as well. I mean, are these more of a mid-cycle slowdown, you think? Or is it truly a recession's on the way? What do you think on the slowing of the economy we're seeing here?
There is a slowdown, but we've slowed down from 9% nominal GDP growth down to 7%, and now to maybe 5%, maybe 4.5%. Just for perspective, 4.5%, 5% nominal GDP growth is pretty good. From 2010 to 2019, we averaged about 4% nominal GDP growth, right? With inflation running about 2%. We average about 2% real growth, right? Inflation adjusted. Right now, maybe inflation, like you said, we just talked about inflation problem being over. Inflation's probably running anywhere between 2.5%, right? Which means we're getting real growth close to trend. And so this is not an economy that is in a recession or close to a recession. Doesn't mean that we cannot have a recession. And that's why I think the Fed should cut.
Yeah, I mean, the reality, we had a lot of growth last year, slowing down a little bit. This is normal, right? If you go back in history, It's not like the stock market always goes up. It's not like the economy always rips roaring higher. We're hitting a little slowdown. But again, if the Fed does the cuts like we talked about, that could unlock a lot in the housing market. That could unlock a lot with small business investment. Some things we haven't really seen that much of lately can be positive. The final thing, Sonu, and this is a little more wonky, so let's try to keep it simple. The yen carry trade is unwinding because the Bank of Japan hiked interest rates, surprising. Remember, a lot of places are cutting rates right now. Let's be very clear. Japan hiked rates. People like to invest in Japanese denominated bonds because they have low yields. And then they go and sell that, and they go buy a higher yielding thing. I know it's a little wonky. The bottom line, when they did that, it upset markets. The Japanese Nikkei fell 12% in one day, the worst one-day drop since the crash of 87, down almost 20% in just 3 days. As someone's honking, I think that people are not happy about the Japanese.
Are they asking you about the yen?
In a yen there, or the Japanese market in a bear market. How worried are you about this unwind of the carry trade?
Not too worried. If it's sort of contained in a way, and looks like it may be, right? Of course, I think it was Warren Buffett who said, when the tide goes out, that's when you see who's swimming naked. Right now, we're kind of finding out who's swimming naked in global markets, who's stretched too thin, who borrowed too much look, if you're borrowing in the yen, if you're, borrowing from the Japanese, you have to first convert your currency to yen. Now, if the yen starts to appreciate, which is what happened, it appreciated very fast over a very short period of time, you lose money there. And then you have to, sell down assets. Which assets do you sell? You sell the stuff that's gone up a lot, like technology stocks. They've gone up a lot, right? So a lot of people, when they had to pull down positions and adjust their portfolios, they've sold off all these things that have run up a lot this year. And that's basically what we've seen.
So as I've said before, Mark Twain, history doesn't repeat itself, it often rhymes. August of 2015, China devalued the yuan, surprising global markets. The first 1,000-point Dow drop ever. Now, 1,000 points back then was a lot bigger deal than 1,000 points right now. So, we've seen these crises happen in August before. The bottom line, is the volatility over? Probably not, everyone. There's probably still more volatility coming. But we've gotten through it, and we're going to get through this one again. One final comment on why we don't think this is a major systemic risk, why we don't think it's the first domino to fall and the whole system goes under like a great financial crisis. The U.S. dollar right now has been weakening. What in the world does that mean to the listeners? Well, when times of stress happen, Sonu, as you know, the dollar is bid up. People flock to the dollar when things are bad. We saw that in 2020. We saw that in 22. And during the regional bank crisis, we saw that. So the reality is, we're not seeing that right now. What would worry me is if the dollar started to strengthen a lot. That could mean, oh boy, this is bigger than what maybe we are expecting. We're not seeing that right now. Any final comments, Sonu, on how bad this will get?
No, look, volatility is part of investing. From September 30th, 2022 through this to August 7th, the day we are recording this video, the S&P 500 is up 50%. 50%. And that's come amid 4-5% pullbacks, 10% correction. Volatility happens. Like I said, it's part of investing.
It's been loud here in New York. It's literally starting to rain as I'm doing this. So I think it's time to wrap up our latest Carson Take 5. So. Listen, we're laughing, but it's not deadly serious. Not deadly, strong way to put it. It's very serious what's happening out there. We are aware. You look at your portfolios; they're less than they were a month ago. They're less than they were a week ago. This is part of the process. Every year has scary moments. Even the best years have bad days, have bad weeks, even maybe a bad month or two. And again, I'll just end it with this. For whatever reason, August, Iraq invaded Kuwait 1990. The Asian contagion 1997. Long-term capital management, Russian ruble crisis 98. 2011, U.S. debt downgrade. 2015, as we said a second ago, China devalues the yuan. And here we are with the yen carry trade in August. I'm not sure why it happens in August, but everybody, volatility and events happen in August. We're going to get through this one just like we did all of those. We will see you next week with the latest Carson Take 5. I'm going to go find an umbrella. Take care, everybody. Thanks.